This is Mark Warner with PropertyMortgageInvestment.com, and I'm here to continue our series on investments and how property investments in the residential market compare with other investments out there. Today I'd like to visit with you about oil and gas investments. There are several different types of oil and gas investments that you can make, but the one I want to talk to you about is drilling opportunities today. And of course, when you drill for oil and gas, you have the opportunity to take a write-off. Today, you can take up to 90% of the intangible drilling expenses as a tax write-off against your ordinary income, and it provides for some excellent tax shelter. The problem is if you turn up a dry hole, or where there's no reserves or oil and gas hydrocarbons that are able to be sold commercially, then the money that you've invested is gone, and you ultimately end up with some tax savings on your taxes. The other tax savings element to oil and gas is the depletion allowance. When you start receiving income from oil and gas, Uncle Sam allows you a 20% depletion allowance, or you only have to pay taxes on 80% of the income, is essentially how that works. In terms of debt reduction, obviously you can finance things like that, but it increases the risk substantially and would only pay out if you were able to make sure that you had the royalties or the income, the working interest income from the oil and gas project to pay down the debt. So if you're investing in a wildcat oil well versus a development field and multiple wells, that's not a good idea to finance wildcat wells, and typically there's not a lot of financing for individual investors in that arena. The other thing that you're looking for is cash flow, and oil and gas investments are all about cash flow. Typically there's a finite period of time where the cash flow continues. Wells, depending on where you're drilling and where you're buying your oil and gas reserves, is the length of time that those oil and gas reserves would go is just dependent on the area you're drilling and how deep it is and what the penetration is in terms of the sand that that the oil and gas might come out of. But cash flow is the primary area that you're looking at, and any appreciation, I give that a partial, only from the standpoint of the price increase of what you pay for it. The challenge you also have is the price of gas, natural gas or oil, goes down at certain instances of time, and thus reduces your cash flow. So the play for oil and gas is primarily from a tax savings as well as cash flow. Once you're into it, it's very difficult to sell it quickly, but there is some liquidity if you do have reserves that you can sell to other people, that cash flow. So in comparison, you have some of the benefits in oil and gas that you have in real estate, but if it's a wildcat oil well drilling, you can lose 100% of your money, which typically isn't the case in a residential property investment. This is Mark Warner with PropertyMortgageInvestment.com, and our continuing series about the comparison between residential property investment and other investment media.